Greetings and welcome. I am making this presentation on behalf of Lessonscape Academy. This short presentation gives you an introduction to the finance management. First of all, let's try to understand what is finance management. You would have come across this word very often in your day-to-day life. When you look at the finance from a business perspective, every money, whether it is equity or debt, it comes at a cost. Obviously, it has to be managed carefully. So, the entire finance management is concerned with optimal mobilization and making sure that the money is used in a most appropriate manner. How do we understand the finance management? It aims at reducing the cost of funds employed, because if you remember, the debt comes at with a cost. We also need to keep the risk under control and ensure the funds are deployed in a proper way. The financial health of the business depends upon how nicely the finance is managed. Also, we have to keep in mind when you manage the finance, the shareholders with maximization principle. Simple thing is, I told you in the first point that every part of the capital comes at a cost. So if the cost is X%, the company is going to diversify and invest in a new project, the return on that particular project should be higher than the cost of capital. Some of the factors which affect what is the cost of raising the funds from different sources, what is the risk involved, and if you go in for a new public issue, there are a lot of costs which are associated with that. The public issue means you have to do underwriting. So all these things adds up to the cost of raising capital. A successful company which has been running for many years, whether they have to make a dividend payment of the accumulated profits to the shareholders or not, obviously it depends upon two reasons. If the company does not require the funds for any future expansion, then it can go in for dividend distribution. But if the company is in an expansionary mode, then obviously you would like to retain the money within the company for expansionary purposes. The decision involved is how much of the profit earned is going to be distributed to shareholders. If you look at the decision, what are the things which comes in? The amount of earnings and the stability of earnings. Some companies want to maintain a stable dividend. As I already told you, if the company made a profit, how much of that can be deployed for growth opportunities? Whether the company is in a position to make the dividend payment, cash flow. Some shareholders require dividend payment. Some require something in the long run in the form of bonus shares and all that. So shareholders' preference also is very important. In countries like India, the dividend distribution can become a costly affair because of dividend distribution tax. And if it is a publicly listed company, you also need to keep in mind what is the stock market reaction and what is the sentiment and how easy it is to raise the capital in the capital market. What are the legal constraints? All these things are going to affect the dividend policy or how much of that is to be paid, whether it is 50%, 100%, or entire money is plowed back into the company for future expansion. What do you mean by trading on equity? This is something very, very important. I want everyone to give attention to this example so that you can understand. I'm sure you will be knowing the capital can be raised either in the form of equity or in the form of a debt. Now, equity is something the shareholders will be willing to wait until the company starts making money. Whereas debt is something where you have to pay fixed amount of interest for every period, irrespective of whether the company is making profit or whether the company is into losses. But again, one more thing, the interest paid for debt is tax deductible. That means before you calculate the profit which is subject to tax, you can deduct the interest as an expense. That's why interest is called as above the line item, whereas any distribution to the equity shareholders are called as below the line item. Let's go into the example. I given two scenarios in terms of how we are going to raise the capital. The first one is the total capital required is 500,000. Now let's assume in scenario 1, the entire 500,000 is raised through equity capital. In scenario 2, the capital is raised from two different sources, only 40% from equity and the remaining 60% through debt or borrowings. Now let's look at two options. The tax rate is 30% in that country. The borrowings comes at an interest rate of 10%. Before calculating interest and tax, the profit of the company stands at 100,000. Now the earning per share in the two different situations will vary. Okay, if you have gone for 500,000, 100% equity capital or 40-60, how does that scenario looks like? Let's look at it in this one. But before we come to the option 2, I want to jump into the option 1, how the results looks like. There is no interest in the first scenario because everything is mobilized through equity capital. Tax it at 30%. Now finally, I want you to look at the earning per share. The earning per share is 1.4. The capital is 500,000 is raised through 50,000 equity shares of 10 each. Whereas in second scenario, the capital is only 200,000 or 20,000 shares. Look at it. The earning per share jumps to 2.45 because this is a scenario, this is an option 1 where the company is making decent profit. Whenever the company is making decent profit, trading on equity method works. I mean, you borrow 60% of the funds required and then you pay them 10% and then the shareholders stand to get benefited with a higher EPS. Now, wait a minute. Is this going to be the scenario always? What if the company's earning before interest and tax is only 40,000? Let's just go back to the option 2. Everything remains same. Instead of 100,000, I am going to say if the company is only making profit, EBIT, earnings before interest and tax, of 40,000. In such scenario, what happens? I want you to see here. The earnings per share in this scenario, option 2, it falls down. Whereas in this case, it went up from 1.4 to 2.45. Here, the number of shares are same, 50,000 and 20,000. The profit available for equity shareholders was 28,000. In the second case, it is only 7,000 after paying tax and all that. This is self-explanatory. So you have something called equity capital, you have something called debt, you have something called preference share capital. All these things, when it comes with a cost, and there is if you have to go for a public issue, then you have additional costs like underwriting, etc. Now I want to ask you a question. Under the scenario, Which is the cheapest source of finance? Is it debenture or is it equity share capital? Debenture cost of capital will be less compared to equity share capital because equity is more risky. Preference shares comes anywhere in between. And the last one is retained earnings. Retained earnings is you make X amount of profit, you keep 80% of that retained within the company, only 20% you distribute as dividend. Ultimately, it is something the profits earned and used for expansionary purposes. So the answer for this one is because without much pain, without going into the public issue, without uncertainty, the retained earnings is the most cheapest source of finance. Thank you very much.